All right, let's dive into one of the most important parts of the entire crypto world for 2026, Ethereum's Layer 2s. What started out as this kind of niche experiment has absolutely blown up into a multi-billion-dollar industry. So in this explainer, we're going to break down how we even got here, who the biggest players are, and where this incredibly high-stakes competition is going next.
But first, to really get why Layer 2s matter so much, we have to go back to the massive problem they were designed to fix. We're talking about a problem that made using Ethereum super expensive and honestly, just a huge headache for pretty much everyone.
I mean, that sounds crazy, right? A single digital transaction. We're not talking about buying a house here, just sending a bit of data, costing more than a fancy dinner. But this was the reality for people using Ethereum, and it really made everyone ask, how on earth did things get this bad? Yep, you heard that right. Over $100. During the peak craziness on the network back in 2024, this was a totally normal fee for just one transaction. A price like that basically kicked most people off the network and created this desperate need for a real solution. That's where Layer 2s come in. Okay, so here's the easiest way to think about it. Imagine Ethereum's main network is just a single-lane road in the middle of a huge city. Now, picture millions of cars all trying to use that one lane at the exact same time. It creates, well, a digital traffic jam of epic proportions.
And on this road, there's a toll. In the crypto world, we call this a gas fee. The problem was, Ethereum's one-lane road could only handle about 15 transactions per second for the entire planet. So to get your transaction through, you had to pay a higher toll than the next person. It basically started a massive bidding war, and those gas fees just went through the roof.
So, if the main road is completely gridlocked, what do? Well, you build an overpass, right? And that is exactly what Layer 2s are. They are the high-speed bypass built to finally solve Ethereum's massive traffic problem.
The way these Layer 2 overpasses work is pretty genius. They take thousands of transactions off that main congested road, process them super fast on their own separate layer, and then they bundle everything up and send just one single summary back down to the main Ethereum chain to keep it all secure. This move boosted capacity from a measly 15 transactions per second to over 300, a total game changer.
But here's the thing. Not all of these overpasses are built the same way. The two main flavors are called optimistic and ZK rollups. Optimistic rollups are, well, optimistic. They just assume all transactions are legit unless someone challenges them. It's fast, but it can mean you have to wait a while to get your money out. ZK rollups, on the other hand, use some seriously advanced math to prove every single transaction is valid right from the start. It's way more complex, but it's also more secure and gives you faster finality.
So this new technology didn't just solve a problem, it kicked off a whole new industry. And by 2026, it's turned into this fierce battle for dominance in an ecosystem worth billions and billions of dollars. So let's take a look at the main players duking it out. $16.6 billion. Now, that's not the value of the entire market. Nope. That is the amount of money locked inside just one Layer 2 network.
That massive number is the total value locked, or TVL, on Arbitrum. It has basically become the financial center of the whole L2 ecosystem, kind of like the Wall Street of Layer 2s. It's holding almost half of all the money in the entire space. Arbitrum's lead is pretty huge. You can see it right there. But it's not alone at the top. You've got Base, which has the giant exchange Coinbase behind it, coming in as a really strong competitor with $10 billion in TVL. And then there's Optimism. It's becoming crystal clear that the market is really starting to rally around just a few of these giants.
And what's really interesting is how they're all playing different games. They aren't all going after the same users. Arbitrum is laser-focused on being the home for serious, high-finance DeFi protocols. Base, with its Coinbase connection, is trying to win over regular people with things like games and social apps. And Optimism? It's playing the long game, trying to build this super chain alliance to connect everything and everyone together.
But that's not where the story ends. You see, the early days of just having cool tech, that's over. We are now in the middle of a major market shakeout, where the only thing that's going to guarantee your survival is actually making money.
Yeah, the harsh reality is that out of the dozens and dozens of Layer 2 projects that popped up, most of them are probably going to fail. They'll become what people are calling zombie chains. They'll still technically work, but there's no real economic activity, no money flowing through them, the hype is gone, and now you have to prove you have a real business.
And you can see that concentration of power right here. The top three players we talked about, Arbitrum, Base, and Optimism, they now handle something like 90% of all transaction volume. It's turning into an oligopoly, and the smaller projects are finding it almost impossible to compete.
All of this has led to what the industry is calling the revenue meta. It's this huge shift in focus. Investors don't just care about cool technology anymore. They want to see cold, hard, sustainable revenue. Layer 2s have to act like real businesses now, not just science experiments.
And when the conversation shifts to profit, you know who shows up to the party? Wall Street. The arrival of huge institutional money is the latest and maybe the biggest twist in the whole L2 story. Take a look at this number, $9.6 billion. Now, this isn't the market cap of another L2, or even all the money invested in the space. Where this number comes from is pretty wild.
That's right. That number is the treasury of one single company, a publicly traded company called Bitcoin. That's one firm listed on the New York Stock Exchange holding almost $10 billion in a massive, massive bet on Ethereum's ecosystem.
And get this, the company holds over 4.3 million ETH. That is more than 3.6% of all the Ethereum in existence. From that stash, they're generating $176 million a year just in staking rewards, which is basically like earning interest for helping to keep the network secure. We're so far beyond small-time speculation here, this is a full-blown institutional investment in Ethereum's future.
And that all brings us to one final big question. We started this explainer talking about how Layer 2s were built to save Ethereum. But now, with over 95% of all transactions happening on them, and with Wall Street giants building entire empires on top, are they helping Ethereum? Or are they becoming so huge, so powerful, that they're basically replacing the very network they were supposed to support? It's something to think about.